President Trump's drill baby drill policy getting a standing ovation at last night's address to Congress. The president saying that he is focused on reducing energy costs as a way to tamper down inflation, very much reiterating some of the rhetoric that he has been saying as of late. Now, his tariff announcements in tandem with an expected boost in supply from OPEC have also weighed on oil prices over the past several sessions. We now have crude below $70 a barrel. Joining us now with more, we want to bring in Fernando Valle. He's Hedgeye Risk Management's energy analyst. Fernando, it's great to have you back here with us. Let's talk about maybe what is the biggest driver in your view of the drop that we've seen in crude prices and really across the board when it comes to oil over the last several days. Is it more tariff driven or is it more OPEC driven?
I think without a question, it has to be OPEC plus increase in supply. I think that was something that most analysts expected to be delayed continuously throughout 2025. We're still not in a super tight oil market. So bringing in as much as 2.2 million barrels a day, which is just over 2% of global supply, back into a market that's not, again, very tight, is almost certain to bring prices down.
So it sounds like you think that OPEC plus output hike outweighs any potential negative impact from tariffs that could lead to a lift in prices.
Yeah, absolutely. And especially because when you hear what's happened since even when we spoke yesterday at night, they're already talking about not pushing those sanctions on Canada or Mexico. And even the energy tariffs themselves are only going to be 10%, not 25%. I think the consumer has been very clear that they can't afford higher prices. And so even if any tariffs came on, I would expect that to be borne more by the refiners and by the oil producers than by the consumer itself, because again, they're already fairly stretched.
And Fernando, you have crude obviously below $78 a barrel. You also had Brent breaking below $70 a barrel this week. I guess the question is, given all of this, what does that downward pressure then potentially look like? How big of a slide could we be potentially seeing?
Well, I know from our sources in the administration that they want oil to go as far down as $50, whether that be Brent or WTI, to help with inflation significantly. And of course, energy is a major component of inflation because it affects nearly every other segment. So it could be pretty painful if they try to get more production out. And again, OPEC Plus has an outsized weight on global supply, even more so than shale could do. I think Scott Bessent, the Treasury Secretary, has talked about trying to raise U.S. production by 3 million barrels of oil or 3 million barrels of oil equivalent. I think that's not feasible, but OPEC can do it, and in relatively short order. So that's, again, not a super tight market. Adding that supply, you could push it down quickly. It is counterbalanced by Germany saying yesterday as well that they're going to increase investment significantly. So that could be higher energy demand. But we'll have to see which one prevails at the end.
Fernando, prices go that low. How much pain is that for some of these larger oil giants?
For the larger, not so bad because they have really strong balance sheets. You know, you look at an Exxon, a Chevron, even a Diamondback, they have pretty strong balance sheets, and they've braced themselves on not having oil price support in the near term. They can withstand this shock. It's really the players that rely more on capital markets, the players that have weaker balance sheets. You know, I'm looking at a Devon Energy, or players that are in more marginal basins like a Chord Energy that is in the Williston Basin, is a pure play on the Bakken. They might have to shut first because their cost structure is just higher than someone in the Midland Basin or in the Permian, like a Diamondback, for example.
And Fernando, since you're already talking individual names, what would you say is the single best investment idea that you have in terms of a company that could be the biggest beneficiary of these lower energy prices?
Well, we tend to like the natural gas names. We have Range Resources as one of our best ideas because on top of getting more demand for natural gas overall from reindustrialization, AI, data centers, you're also getting more demand for LNG that's going to Germany, as I mentioned, and other parts of Europe. And then on top of this, the tariffs and lower oil price will decrease the production of associated gas in the U.S. So that would lower the overall supply of natural gas, which would be positive for someone like Range that does dry gas, doesn't produce oil, mostly natural gas.
And since you mentioned your sources within the administration, Fernando, I'm just curious what you've heard from folks in the White House in terms of potential carve-outs for energy suppliers, not just from Mexico and Canada, but even as the administration teases out further tariffs to come from other countries as well.
Well, our main importers are Canada and Mexico. So I think that considering that OPEC Plus probably was influenced by the Trump administration, we don't import significant volumes from OPEC anymore. But I would expect that also would not be taxed at the same level as other tariffs.